Hey guys, it's Brenna, CEO and co-founder of the Mortgage Shop. I'm coming to you because all of you have questions about interest rates, why they are going higher, why there are points to be paid to get a certain interest rate, things of that nature. I see a lot of times people are saying that the interest rate is too high for their property to cash flow, things like that. And so I kind of wanted to go over all of that in a video for you guys. And I'm going to use today's current rates to give you an example. So as of today, April 27th, 2022, those are the rates. So if you watch this at a later date and the rates are totally different, that is why, but it's still the same example. You can still use those numbers during that day that you were looking at interest rates to do the same thing. And if your loan originator or your mortgage lender that you're using cannot do that for you, then you need to find another loan originator or mortgage company that knows and specializes in these short-term rentals, long-term rentals, and vacation home loans. So initially, I believe it was last year, Fannie Mae came out with what was known as LLPAs, or loan level pricing adjustments. That means that they put a price, a charge basically, for interest rates for second home loans and investment properties. The reason being is when the COVID pandemic happened, everybody freaked out. Everybody thought that they were going to lose their jobs. It was going to be the biggest, depression, maybe another Great Depression, things like that. And so interest rates plummeted. The cost to borrow money these banks were seeing were crazy low. And so therefore our interest rates for mortgages became low. And then you may have heard that that was the refinance boom and everybody was refinancing. And that's why, because the interest rates were so low. So if you're getting into this after COVID and not before COVID, those are not the normal interest rates. So normal interest rates, I think I saw before COVID hit, was probably a 5.375 to 5.5% interest rate, good credit, 20% down, things like that for an investment property. And then now they are a little bit higher. They went down into like the 3.75 range in COVID, which is awesome and insane. But those things don't last forever because it was a pandemic. And so now they are up. And I will explain to you why they are up as well. So not only did Fannie Mae put loan level pricing adjustments in place, there's also an increase by the Fed for interest rates. So let's go over the loan level pricing adjustments first with Fannie Mae. The easiest way I can explain this to you guys is Fannie Mae can basically have their cake and eat it too. So they saw that all of these people were borrowing. They knew that there was not a lot of money out there to be borrowed because everybody was already borrowing it. They wanted to get a piece of the pie as well, and they wanted to slow that down because they knew that inflation was probably coming. So they placed like points on an interest rate, which means they are charging you a percentage of the loan amount for that interest rate for second homes and investment properties. Now, fast forward, the Fed is now curbing inflation and increasing interest rates and separate occurrences. The next one will be May 4th. Most lenders already have raised their interest rates in preparation for that rate increase the Fed has hinted to and told us that will most likely happen. Now, I'm not a wizard. I am not a fortune teller. I cannot see into the future. However, with my previous experience in seeing interest rates and studying them and understanding them, the Fed is increasing interest rates, like I said, to curb inflation. They aren't making as much money anymore, physical dollars. And so a lot of people borrowed that money, those dollars, with that very low interest rate in COVID. So if people borrow all of the money, where does it go? That's the problem. So there's so much money out there, so much debt basically, that has been lent out that the Fed wants to curb that, increase interest rates, and so that will deter some of the population from purchasing properties. Now, this is why I want to explain it to you, because this is going to separate the sheep from the wolves in this instance. When people were purchasing during COVID, they weren't really thinking, they knew the numbers would probably work because interest rates were so low. But now the interest rates have increased. You will still cash flow. You just have to do your homework now. So you have to do a little bit of work, or have your loan originator, look at the numbers with you, which I'm about to do, and show you the actual numbers. Because if you run the numbers and you run your goals, they won't lie to you. Simply done in an Excel spreadsheet, or just written out like I've written it out in this, what I'm about to show you my screen. So with that being said, your interest rate will now cost a percentage of the loan. I see a lot of lenders or mortgage companies that don't offer 10% down jumbo on a second home loan. And the way that they fight that to get somebody's business, as opposed to another company that does specialize in this, and do offer that 10 to 10.01 down up to a $2 million loan amount, AKA the mortgage shop. They actually have scripts, like they don't even know that much about investment properties. They have scripts to read to these clients on the phone, which is insane to me. And they say, well, a 10% down loan doesn't exist anymore, because basically your down payment is 10%, but the points that you're paying for that interest rate will equal 15 to 20% down. So will equal 5 to 10% more down. And therefore you're paying 15 to 20% down instead of 10%. And then they'll quote you their 20% interest rate with like no points, basically, or very little points, and say, see, you're saving money. That's all fine and well if you want to have a 20% down second home loan or investment loan. But I'm going to show you some numbers that I ran today on current market interest rates, so you can see that that is a lie, and they are just trying to get your business. So if you've heard of somebody reading off of the script to talk to you, that is not good. You want a loan originator or a mortgage company with experience to talk to you from their personal experiences, what they have seen in the market. They've been through these market shifts, things of that nature. So with that being said, I'm going to share my screen. Let's see. Here we go. And let me pull up my notes. All right, so rates, points, and down payment options. The argument from the other lenders: 10 to 10.01% down payment loans don't really exist because the points those brokers charge for the rate equal at least 15 to 20% down in total. Lies is what I put. Lies. Don't tell lies. So I put all of this in a spreadsheet so you guys can see the difference. There are going to be more points for an interest rate. And when I say point, it's a percentage. So if I say 1 point, that means 1% times the loan amount, guys, not the purchase price, the loan amount. There will be more points or percentage for that interest rate charged for a 10% or 10.01% down loan. However, it will not equate to that extra 5% to get it to a 15% down payment, or an extra 10% to get it to that 20% down payment. So let's go through that 10% first. So 10.01% down. I don't know why they do the 0.01 for jumbo loans. We are doing a $1.5 million purchase price in this scenario. So 10.01% down is $150,150. So let's look at the interest rates today. There's a 5.5 for the 10.01% down at 2.676 points. That's $36,125.15 in cost. That sounds like a lot. It is a lot for points. However, it is less than the additional 5% that you have to get to a 15% down payment. 5% of that $1.5 million purchase price is $75,000. So you are paying less to get that 10% down at that 5.5 interest rate. 6% is the same thing, except again, remember I said the lower the interest rate, the more points that it will be for that interest rate. So 6% is at 1.713% today. or points today for 6%, excuse me, at $26,126.10. So that's 1.713% times that $1.5 million loan amount. Again, that is less than putting an additional 5% to equal 15% down payment of that $75,000. So 23,126.10 and 36,125.15 is a lot less than $75,000. Now let's go, if you do have the funds and you want to put down more. So 15% down is $225,000. So let's look at the difference. 150, 150, 150, or 225. 225 is that 15%. Now, interest rates, the points for those rates decrease. Why? Because you are putting a little bit more down. So 5.5 with 1.991 points for $25,391.25. So you are putting more of a down payment. However, it's less of points. And again, to add that extra 5% to equal 20% down is less than that 75,000, which is 5% of 1.5 million. 6% is only at 1.153 points or 14,706.75 for that interest rate. Again, a lot less than 75,000 to bring that up to 20% down payment. Now, let's say you do have 20% to play with and you don't want to put your money in points. That's totally fine. These scenarios are for people that do not have that 20% or do not want to put 20% down. But let's now say that you have the 20% and you are good with putting it down as a down payment for a second home or investment property. So 20% down of 1.5 million would be $300,000 in a down payment. Here are the options. Now that you put 20% down, you've got more options, right? You've got the ARMs, adjustable rate mortgages, which sounds scary, but again, you want to be educated. So I'm going to educate you a little bit. I'll do another video at some other point about ARMs. But a 7/6 ARM is only 4.75%, guys, 4.75% with only 0.045 of a point cost, which means $540 for that interest rate. Not a lot. 4.75 is like a dream right now to me, because if you look at the other loan options, those interest rates are higher. However, they still work in cash flow, and I'm going to show you the difference in interest rate payments below and explain that as well. It's not as much as you think, and do not be sticker price shocked by these interest rates. So a 7/6 ARM would be 4.75, went through that. 7/6, 7 years fixed. That's what the first number means, 7-year fixed. Your interest rate will be fixed for those 7 years. How many of you sell your property prior to 7 years? A lot of people do not hold their properties for more than 3 to 5 years because they either 1031 exchange to get a larger property in the area, or they 1031 exchange to get out of that market and get in a separate market. So keep that in mind. 10/6 ARM, again, 10 years fixed at that interest rate, would be 4.875 with a credit back to you. So you hardly see that anymore either. You're not getting charged for that interest rate. 4.875 10/6 ARM would be a credit towards your closing costs of $3,144. Now the 30-year fix, you go back to the 30-year fix, you don't have to worry about refinancing in those before 7 years for that 7/6 ARM, or before 10 years for that 10/6 ARM. You're just good. You're going to keep the interest rate, maybe refinance later down the road. So you go back to that 5.5 points or 5.5% with 0.615 of a point. So that's $7,380 for 5.5% with 20% down. Or you have a 5.875% with a credit. Again, you don't see that hardly ever. A credit of $996 towards your closing costs. Now, this is with 20% down. So if you wanted, you have that money and you want it to go to your equity in your property as opposed to paying for points, you can. But look at these numbers. 150 down payment, 225 down payment, 300,000 down payment. You would never equal that 300,000 if you didn't want to by just paying the highest amount of cost, which is this line right here. So let's move down and show the difference. To summarize for the 10% down, with less points paid than putting an extra 5% down, so you're paying points for that interest rate, still doing the 10% down, and you're still putting less down than it would be to get to that 15% down payment. Total down payment plus points would be $186,275.15 for 5.5. So let's look back up here. 15% down is $225 down payment. Now, 10% with just those points is $186,275.15 for 5.5%. Does that equal each other? No. Are you paying 15% for a 10% down loan? No, you are not. That's why I say lies, lies. All right, let's go even further. 6% down. Your payment for that is $8,093.03. Or I forgot to bold this as well. Your cash to close for this one is $173,276.10. Again, a lot less than $225 down payment for 15%. All right, so let's compare the payments through those interest rates. So a 5.5% interest rate, principal, interest, taxes, and insurance. That's what PITI means. I will refer to that like that for the rest of the video. PITI is $7,239.91 with a 6% interest rate. Again, it's not going to be this much of a difference on lower purchase prices. I am going off of a really high purchase price just so you can see numbers and so you can see that I'm not trying to fluff any numbers. So PITI for 6% is $8,093.03. The difference between those two payments is $853.12. Let's go back. What was that cost for that 5.5% interest rate? That cost, the cost difference was $12,999.15 between what you would pay for the 5.5% interest rate and the 6% interest rate. So the difference between these two numbers is the $12,999.15 for that 10% down. To get that lower interest rate of 5.5% and the points that you're paying for that rate, it would take you 1 year and 5 months to see that interest rate accrue, or to see that interest accrue to equal that extra $12,999.15 you were putting down to lower your interest rate to that 5.5% versus taking the 6%. So again, these numbers do not lie. There is a bit of a difference for this one since it's such a large property in payment per month. But you can either pay those points up front and take that $12,999.15 out of your pocket and not see it again, or you can make that $12,999.15 last for a year and 5 months. What can you do within that time period? You can refinance if the interest rate's lower, which right now we are in the thick of it, of them increasing interest rates. But once they curb inflation, guess what? Why would they need to keep interest rates high? They wouldn't. They would want people to start borrowing again because they don't want the opposite to happen where nobody's borrowing anything and banks and the secondary market aren't making any money. So keep that in mind. Now let's look at 15% down. I know this is probably really boring, guys, but it's not if you are putting this into perspective because it's your money that you're about to be making for this year. It's your money that you're going to be making for the life of this property you are purchasing. It is your family's money that you are going to hand down and create generational wealth for your family. So keep that in mind. 15% down with points for that 5.5 loan, 5.5% interest rate for the loan would be $250,391.25. So this includes your down payment plus the cost for the interest rate. Again, 15%, that $250,391 is different and lower than $300,000 down payment for 20%. And then if you wanted to do the 6% interest rate, it goes down a little bit. So your down payment plus cost for that interest rate is $239,706.75, which again is a lot lower than $300,000 down payment for 20%. So Let's compare these numbers now. So 5.5%, $7,239.91 per month, PITI. 6%, $7,644.27. This is the big one, guys. This is where I want you to see, like, if you had a lower purchase price and a lower loan amount, these numbers are insane when you really work them and you're like, whoa, there's not really that much difference. And me paying for this lower interest rate may not be as advantageous as I thought. So the payment difference per month is $404.36. If you take the 6% interest rate, I say it would be more beneficial for your pocket right now. And here's why. You get to keep that extra, the difference between $10,684.50. So the difference between those points that you would pay for that 15% down is $10,684.50. It would take you 2 years and 3 months to see that interest accrue to equal that extra $10,684.50 that you are putting down for that lower interest rate. That is insane. I keep telling my customers, okay, so your difference, let's say at a really large scale, 1.5 million cost house. Okay, your rate goes up $404.36 per month. All right, add a coffee bar, add some biscottis, add some, I don't know, whatever people like to eat with coffee, I guess, maybe Kahlua, I'm not sure. But you can add things. You can up your nightly rate, $10, $20, $25, $30 if needed. And you will see that money back within the first 2 to 3 rentals that you get booked for that month. Again, the 20% down for the arms is very, very attractive. There's some that you're not even paying points. You're getting credit back for some of these interest rates, and it's insane. It's 4.875. So if you have the funds to put down, yes, I would recommend put them down for the 20% down and then get an interest rate where you don't have to pay points to, because all your money's going to that equity. But if you aren't in that boat and you don't have the $300,000 down payment, but you do have, let's say for 10%, you have $190,000, then you would have enough for your down payment plus the cost for that interest rate. So that might be where you're at. And people are like, well, should I wait? If you wait, this is all if, and this is the thing, that's the game with investing in anything. Should I wait? Should I not wait? You are investing in that moment, in that time. So let's say you wait, purchase price goes up. Then you're trying to scramble to find even more money for that down payment and interest rate. It's not guaranteed that the interest rates are going to go that much lower, but I believe that they will go lower after the Fed curbs inflation, which I think is going to be around October. Again, I'm not a mind reader or fortune teller, but that's when I think it's going to start decreasing, September, October. However, when those decrease, the properties may go back up again because it could be a seller's market when all of these people have the money to buy. So keep that in mind. Don't buy a property that you aren't comfortable with. But if you do see a property that you really like and that you could make money on, or that you would love to vacation as a home for your family, don't try to wait, because I've never had a client say in the history of me doing this job, I wish I didn't buy. Every single one, even myself, is saying, oh my gosh, I wish I would have bought. I wish I would, even with the interest rates, like I wish I would have gotten that property. I psyched myself out. I keep looking at it every day. I know it's under contract, and I'm really hoping that it falls out of contract because I really want that property. So keep that in mind. Don't be scared of numbers, guys. We, your mortgage professionals, can run the numbers for you to see if those numbers work for you. If they don't, then we don't want you to go into something that you're uncomfortable with. So that's why we're here to run the numbers with you, and make sure that that decision is good for you. And we will run the numbers like the one that you just saw that I did, I actually was something I sent to a customer today. He had gone to a mortgage company that said that little lie, oh, they don't really have 10% down. It's at least 15 to 20% down after you pay those points. Nope. So I just proved them wrong in that email with all of those numbers that I sent him. And I'm doing it here on this. And now guess what? I have a customer that's wanting to purchase in that price range. And it's probably going to be a for life customer, because I'm not just trying to get one deal. I'm trying to see if it makes sense for him. And if he doesn't want to put 20% down, he doesn't have to. So do not go with a mortgage company that is making you put 20% down if you do not have to. I think that's all I have today. I will get off my soapbox about that, but just keep in mind, when times get tough, that's when some shady people in the lending industry can come out. And that's when they're trying to just pad their paycheck sooner rather than later. So if somebody's pressuring you into, you need to buy now, 10% second home loans are going away, don't listen to them. Call somebody that you trust. Talk to your realtor. Talk to us. I mean, if you don't even go with us for your loan, talk to us and say, is this true? Every Wednesday at 11 a.m. Eastern, I have a mortgage prep class that is just informal like this, a Zoom meeting. I get on there and explain all products across the board for investment loans and short-term rentals and second home loans and things of that nature. And then I do the frequently asked questions, and then I open it up for all of you to ask questions. And that way you may hear somebody that says a question or asks a question that you may not have even thought of, but you will have that question going down the road. So keep that in mind. You can join as many times as you want. I'm going to try to make some more of these videos for you to educate you on things like what's the difference between a 30-year fixed and a 7/6 ARM, things of that nature. So thanks for listening. Again, I'm going to step off my soapbox now, and I hope you guys have a great rest of your day. Hey guys, my name is Brenna. I am coming to you from the Mortgage Shop. I am the CEO and co-founder of the Mortgage Shop. We do specifically, Hey guys, it's Brenna with the Mortgage Shop.